REITs and physical real estate are both real estate, but they are not the same investment. One can be bought in a brokerage account in seconds. The other may require a down payment, a mortgage, inspections, insurance, repairs, tenants, and months of paperwork. One gives you liquidity and diversification. The other gives you control and direct ownership. So the question is not just, is real estate a good investment? The real question is, which version of real estate actually wins in 2026? REITs or physical rental properties? And the answer is more interesting than most people think. Because real estate is not one investment, it is a category with very different ways to win and lose. In this video, we are going to compare REITs and physical real estate across capital, liquidity, diversification, management, leverage, income, taxes, risk, and investor fit. And by the end, you should have a much clearer idea of which one makes more sense for your situation. Let's start with REITs. A REIT is a real estate investment trust. In simple terms, REITs are companies that own, operate, or finance income-producing real estate. And instead of buying one physical property yourself, you can buy shares of a REIT through the stock market. That gives investors access to real estate sectors like industrial properties, apartments, retail, healthcare, data centers, self-storage, and net lease properties. This is one of the big advantages of REITs. You can get exposure to types of real estate that would be extremely difficult to buy directly as an individual investor. Most people cannot go out and buy a data center, a national logistics portfolio, or hundreds of net lease properties, but they can buy REIT exposure. REITs also offer liquidity, professional management, diversification, and dividend income. That makes them feel more like stocks, even though the underlying business is tied to real estate. REITs turn real estate into a liquid, diversified, stock-like investment. Now, compare that with physical real estate. Physical real estate is direct ownership. This could mean buying a single-family rental, a duplex, a small multifamily property, a short-term rental, or even a commercial property. Instead of buying shares of a company, you own the property yourself. That gives you more control. You choose the location. You negotiate the purchase. You decide whether to renovate. You choose how to manage rent, tenants, repairs, and financing. And if you buy well, improve the property, and manage it properly, physical real estate can be a powerful wealth-building tool. But control is not free. Control comes with responsibility. The property still needs maintenance. Tenants may leave. Vacancy can happen. Insurance costs can rise. Property taxes can increase. Repairs can appear at the worst possible time. So physical real estate gives control, but control comes with responsibility. And that difference becomes very clear when we look at the first major comparison, starting capital. The first big difference is starting capital. REITs are much easier to start with. You can buy them through a brokerage account. You can start small. You can buy one REIT, several REITs, or a REIT ETF. And you do not need a down payment, closing costs, or reserve fund just to begin. Physical real estate is very different. To buy a rental property, you usually need a down payment, closing costs, cash reserves, insurance, repairs, and money for unexpected expenses. And in 2026, the entry point is not easy. The average 30-year fixed mortgage rate was 6.49% on July 9, 2026, and the median existing home price in June 2026 was $440,600. That makes the math more difficult for many new investors. REITs are easier to start. Physical real estate is harder to enter. But capital is only one part of the comparison. The next difference is liquidity. The second big difference is liquidity. REITs are liquid. If you own a publicly traded REIT, you can usually buy or sell shares during market hours. That gives you flexibility. You can increase a position, reduce a position, rebalance, or exit if your thesis changes. Physical real estate is not like that. Selling a property can take weeks or months. You may need an agent. You may need inspections. You may need negotiations. The buyer may need financing. And the deal can still fall apart late in the process. On top of that, selling physical real estate usually involves meaningful transaction costs. So liquidity is a major advantage for REITs, but it also has a downside. Because if something is easy to sell, investors may sell emotionally during volatility. Physical real estate can force patience because it is difficult to trade. REITs are liquid. Physical real estate can trap your capital for years. And that brings us to another important difference: diversification. The third difference is diversification. REITs can provide exposure to many properties, many tenants, many sectors, and many regions. A single REIT may own hundreds or thousands of properties. A REIT ETF may spread exposure across several real estate sectors. That can reduce dependence on one building, one tenant, or one local market. Physical real estate is usually much more concentrated, especially for beginners. Many investors start with one rental property. That means one city, one neighborhood, one property, and maybe one tenant. If that tenant leaves, stops paying, or damages the property, the impact can be significant. If that local market weakens, the investor feels it directly. So even though people often say real estate is diversified, one rental property is not diversified real estate. It is concentrated real estate. REITs usually win on diversification, but physical real estate gives more direct control. And direct control leads to the next question: how much work does it take? The fourth difference is work and management. REITs are professionally managed. The investor does not personally deal with tenant calls. The investor does not fix leaks. The investor does not manage evictions. The investor does not negotiate every lease. The investor owns shares, and the company handles the real estate operations. Physical real estate can be very different. You may need to handle repairs, maintenance, tenant issues, vacancy, contractors, insurance claims, local rules, and unexpected calls. You can hire a property manager, but that reduces cash flow. And if the property manager is not good, it can create new problems. This is why people sometimes overestimate how passive rental income really is. Yes, rental properties can create income, but that income may come with work, stress, and decision-making. Rental income is not always passive income. So if you want real estate exposure without operating real estate, REITs may be more practical. But physical real estate has one powerful advantage that REITs cannot replicate in the same way: leverage. The fifth difference is leverage. Physical real estate often allows investors to control a large asset with a smaller amount of money up front. For example, if an investor uses a mortgage, they may control the full property while only putting down a portion of the purchase price. That can amplify returns if the property appreciates and the cash flow works. Fixed-rate debt can also become more attractive over time if rents rise and the debt payment stays stable. But leverage cuts both ways. High mortgage rates can pressure returns. Vacancy can turn a good spreadsheet into negative cash flow. Unexpected repairs can destroy the annual profit. And falling property values can make leverage painful. REITs also use debt, but it is inside the company. As a REIT investor, you are not personally signing the mortgage on one property. That can reduce personal operational risk. Leverage can build wealth faster, but it can also expose bad math faster. And that bad math often shows up when investors confuse income with profit. The sixth difference is income. REITs may pay regular dividends. That can be simple for investors. The dividend arrives in the brokerage account, and the investor does not have to collect rent directly. But REIT dividends are not guaranteed. They can be affected by interest rates, property performance, tenant health, debt costs, and the real estate cycle. Physical real estate creates rental income, and rental income can feel more direct. A tenant pays rent every month, but rent is not profit. From gross rent, you still need to subtract the mortgage, property taxes, insurance, repairs, vacancy, capital expenditures, and management. A property can have strong gross rent and weak net cash flow. This is one of the most common mistakes new real estate investors make. They look at rent before expenses. The correct number is net cash flow, after realistic costs. Rent is not profit. Dividend yield is not guaranteed income. And after income, we need to talk about one of the most important differences: taxes. The seventh difference is taxes. REITs can be convenient, but REIT dividends may be less tax efficient in taxable accounts. That does not make REITs bad. It just means account location matters. For some investors, REITs may fit better in tax-advantaged accounts, depending on their overall plan. Physical real estate can have powerful tax tools: depreciation, mortgage interest, property taxes, possible 1031 exchanges, and other deductions depending on the investor and the property. But these advantages come with complexity. You need better records. You may need professional tax help. And the rules can depend heavily on your situation. This is where physical real estate can be powerful, but also more complicated. Taxes can make physical real estate powerful, but only if the investor understands the rules. Now we have compared capital, liquidity, diversification, work, leverage, income, and taxes. So before we decide which one wins, this is a good point for a quick pause.
This is the kind of real estate investing breakdown we focus on at Boring Money Wins. Not just saying buy real estate, not pretending rental properties are always passive, not pretending REITs are always better just because they are easier. The goal is to understand the trade-offs clearly: costs, risk, liquidity, taxes, effort, and what actually fits the investor. If you like no hype real estate investing analysis, hit the like button and subscribe to the channel. It helps the channel grow, and it tells YouTube to show more practical investing content to people who want simple investing without the noise. Now, let's turn the comparison into the real question. When do REITs actually win?
REITs may win when the investor wants real estate exposure without becoming a landlord. They can be a better fit for someone who wants simplicity, liquidity, diversification, professional management, and a lower starting capital requirement. REITs can also give access to sectors that are difficult for individual investors to buy directly: data centers, industrial logistics, healthcare real estate, self-storage, net lease portfolios, large residential portfolios. For someone who does not want tenant calls, repairs, property managers, local regulations, or concentrated exposure to one property, REITs can make a lot of sense. They are not risk-free. REIT prices can be volatile. Interest rates matter. Debt matters. Valuation matters. But REITs can make real estate investing much easier to execute. REITs may win when the investor wants real estate exposure without becoming a landlord. But that does not mean physical real estate has no advantage. For the right investor, it can still be very powerful. Physical real estate may win when the investor has skill, patience, capital, and local edge. This is the key difference. Physical real estate rewards execution. If you know a local market well, you may find deals that public markets do not price perfectly. You may negotiate directly. You may improve a property. You may increase rents. You may use financing wisely. You may create value through better management. That is very different from buying a REIT at the market price. Physical real estate can give you more control over the asset, but it also demands more from you. You need to understand the neighborhood, the property condition, the tenant market, the financing, the repairs, the legal rules, and the realistic cash flow. Physical real estate may win when the investor has skill, patience, capital, and local edge. So the winner depends heavily on the investor. And that leads to the biggest mistake people make when comparing these two. The biggest mistake is comparing only headline returns. For example, someone may compare a REIT dividend yield with gross rent from a rental property, but that is not a fair comparison. Gross rent is not net return. You need to subtract maintenance, vacancy, insurance, property taxes, repairs, capex, management, transaction costs, and your own time. On the REIT side, you also need to consider dividend taxes, valuation, interest rate sensitivity, and market volatility. A proper comparison looks at net return, risk, effort, liquidity, concentration, and taxes. That is why there is no universal winner. The better question is not which asset has the biggest headline return. The better question is which asset fits the investor after costs, risk, and effort. The winner is not the asset with the biggest headline return. It is the asset that fits the investor after costs, risk, and effort. Now let's bring everything together into the final verdict. So, REITs versus physical real estate in 2026. Which actually wins? REITs may win in simplicity, liquidity, diversification, easy access, and avoiding landlord work. Physical real estate may win in control, leverage, tax potential, direct ownership, and local market edge. For a beginner or a passive investor, REITs may be more practical. For an investor with capital, patience, skill, and a strong understanding of a local market, physical real estate may win. And for many investors, the answer may be both. REITs for easy diversified exposure, physical real estate for direct ownership and local opportunities. The important point is not to romanticize either one. REITs are not risk-free. Rental properties are not automatically passive, and real estate investing is not one simple category. The best real estate strategy is not the one that sounds richest. It is the one you can actually execute through cycles. And boring money usually wins because boring money usually survives.